Hello, everyone. This is Ted Bauman here, editor of the Bauman Daily, with your regular Friday video. I'm also the editor of Bauman A Letter and of Profit Switch, which you can subscribe to by clicking at this little icon above my left shoulder. It's been a fairly torrid time in the markets recently. That seems to be the key characteristic of markets this year. And as I've said before, it seems to happen every first quarter. But this year, I think we have a different set of circumstances, which makes it a little more meaningful. The key thing is that the markets clearly do not believe Fed Chairman Powell when he says that they are going to maintain low interest rates into the next couple of years. The 10-year Treasury yield has risen again. This morning it hit around 1.76. I'm going to talk to a couple of charts on that in a moment, but the key thing is that we're revisiting the type of growth disease, I guess you could say, the problem with growth stocks, the stocks that have done so well over the last year, and we're looking at a very significant rotation out of them. That's happening today as I record this on Thursday for release on Friday. Now, whether that money flows into something else and boosts it is another question. But what we do know is that right now, growth stocks are getting hammered today as a result of the market's reaction to the Fed. It's not that the Fed, personally, when they say they're going to do this, I believe them. When they say they're going to keep interest rates low, the question is, can they actually keep the 10-year particularly within a moderate range? So let's first look at a couple of charts to see what a moderate range would mean for the 10-year Treasury. And just before we do, remember the key thing here that as bond yields go up, it makes growth stocks less attractive for two basic reasons. One is because there's an alternative in the form of investing in bonds and getting a yield on them. And the second is that the discounted cash flow analysis that most high-level investors use to judge the future value of a stock means that as yields go up, the future value of those companies' earnings go down, and so therefore they're worth less in the present. So let's look first at a couple of charts that show the long-term trend in interest rates. This first one shows interest rates going back to 1981, when Chairman Volcker of the Fed at that time determined that he was going to squeeze inflation out of the economy, and boy, did he. Now you can see that at that time, basically the yields were far higher. That right-hand column is not an indicator of yield, of course. That is simply the relative to the 1981 starting point. So it's the change from then. Since then, we've seen yields on 10-year Treasury bonds basically fall by 85%. In other words, relative to what they were back then, they are 85% lower. And look at that. That is an unmistakable trend line. It has just been down, down, down. Now, I've put a crosshair on the current price, which is today, 18 March. And as you can see from there, we're still way below pretty much anywhere rates have been on the 10-year bond for a long, long time. The only time that they've been lower than this is during last year when the Fed lowered interest rates and everybody expected the economy to crash, and the 10-year bond yield fell to historic lows. But the key message here is that this is still one of the lowest interest rates on the 10-year Treasury bond that we have ever seen. Now here's a second chart that looks at the same information but over a shorter time scale. It takes us back essentially to the beginning of January 2009, which was at the height of the great financial crisis. And again, we are still well below the Treasury yields that we saw pretty much during any of that time. They fell a little bit below that in 2012, 2013. They fell again in just before the election in 2016. When they fell in 2013, that was the taper tantrum. That was basically the Fed was sending a message that it was going to stop buying bonds out of the market, and that led people to flee the bonds, the 10-year Treasury, and had pushed its interest rate down. But look how quickly it rose after that. As soon as the Fed kind of reversed course, rates shot up again just as quickly as they have this year. So you can, the slope of the line back there in 2013, 2014 is just as rapid as it is now. Same thing happened again after the conclusion of the electoral cycle in 2016, also a very rapid increase in rates. And they actually increased pretty strongly compared to where they are now. And they only really began to fall at a rapid clip at the beginning of 2019. They stabilized a bit at the end of the year, and of course they fell off a cliff at the beginning of 2020. So the message here is, number one, that we are looking at still historically low 10-year bond yields relative to where they've been in the past. And number two, that even relative to the recent past, the last 10-year boom that we've seen in stocks, even the boom that we've seen in growth stocks since roughly mid-2019, interest rates are still low. So the critical thing here is not the level of interest rates, it's where people think they're going to go in the future. So on that score, really it comes down to whether investors trust the Fed or not. And clearly, the market is saying that whatever the Fed says about their intentions not to raise interest rates, they feel that they're going to be forced to do so. Now, my position on this is pretty clear. I agree with the Fed that there's going to be a short-term boost in prices because of the low baseline from 1 year ago. Of course, prices were falling last year because of the pandemic was just in its early stages. So relative to a year ago, yes, we're going to see big increases. And yes, we're going to see some supply chain issues. But the real question that drives inflation is whether or not there are enough productive resources in the economy to produce all the goods people want to buy. And on that score, we still have 10 million people out of work and a lot of unemployed capital. There's still a lot of imports that we can bring in to feed consumer demand. So even if we do have short-term technical inflation, I don't see a structural basis for it. Nevertheless, the market is concerned about it. So let's look at what those concerns amount to. The secondary problem that we're facing right now is that the level of growth of the top technology stocks in proportion to the market as a whole has just gone haywire over the last 10 years, or the last year in particular. I'm going to show you a chart that takes us back to really just before the pandemic to demonstrate that. Here's that chart. It shows the pink line is the Nasdaq 100, the top 100 technology stocks, or rather the top 100 stocks listed on the Nasdaq, which includes primarily technology stocks. Now, at the point here, I've put a crosshair roughly where I think the the Nasdaq 100 should be relative to the S&P 100 or 500, which is the green line. So if you go back to 2018, 2019, right up until the beginning of 2020, when we started to see a divergence, the two were not that much separate. It was only at the beginning of 2020, just before the drop in overall prices because of the coronavirus, that the index, the Nasdaq 100 began to pull away. But then it just went off like a rocket, and it has become more and more overvalued relative to the S&P 500. And that, of course, is because of two things. One, with real economy stocks, cyclicals, not doing anything because of the effect of the pandemic, and with interest rates so low, it made growth stocks relatively attractive. And the problem now is that they are becoming less so as interest rates rise. Now, the question is, how much could the Nasdaq 100, the top stocks, primarily tech stocks, how much could they fall if this turns into a rout? In other words, if we start to see a significant pullback and a full-on rotation into cyclicals and away from growth stocks. Well, right now, in terms of forward price to earnings ratio, the valuations for the Nasdaq are trading at 57% above the levels that we saw during the last long-term bull cycle for the Nasdaq. And what that means is that we could see a decline of something like that if we were to return back to those levels, which are historically levels that the market is willing to trade at. So basically right now, the average long-term, or rather the average forward price to earnings ratio, the next 12 months price to earnings estimates is 33. If it fell down to 21, that would mean almost a 60% drop in the level of the Nasdaq. Personally, I don't think it's going to fall that far, because one of the things that we've seen recently is that a lot of companies have appeared on the scene that have good growth prospects, even if right now they are overvalued relative to a technical evaluation of their value using discounted cash flow analysis. Now, let's ask the question again. Let's flash that chart back up again. If the Nasdaq fell back to the kind of relationship it had to the rest of the market, i.e. that green line before 2019, you'd be looking at a minimum of a 20% decline from here. So in other words, folks, what that means is that we're looking probably, if the Nasdaq does pull back, if the high flyers pull back, then we probably are going to see a pullback of around 20%, and that could involve some of the top companies in the Nasdaq right now. And I'm going to show you a chart of those in a moment. So what's the deal? Well, the bottom line is that if you bought a growth-oriented technology stock towards the peak last year, if you bought a company like Zoom, for example, near its peak valuation, you have two choices at this point. One is you can eat your losses, or the second is that you can wait and hope that that company grows into its valuation someday. What that means is that you've got to actually look at the fundamental prospects of these technology companies. This is something I've been saying for a while now. You can't just say, ooh, it's a cool idea, I'm going to buy that. The company actually has to be able to demonstrate that it can produce goods that people want and that are willing to pay for, and that they can do so at a sufficient premium to their operating cost to generate a profit. That may come in the future, but the revenue growth is the key thing. So fundamentally, what everybody's going to be looking at for the high growth stocks of the last year is whether they can grow revenue. We're going to stop looking at the growth in stock prices and start looking in growth in revenue. So let's look at the kind of companies that could get crushed. I generated a chart that shows all of the companies in the Nasdaq 100 that have a price to sales ratio in excess of 15. Right at the very top, Moderna, a bit of an outlier since it is a pharmaceutical company, but Zoom up there, Atlassian, a highly valued but still unprofitable software as a service company, Okta, DocuSign, Tesla, Pinduoduo, Chinese, Nvidia, Intuitive Surgical, Mercado Libre, a big e-commerce company down in Latin America, Dexcom, Peloton, Align, Match, Verisign, Ansys, Adobe Autodesk, and IDEX Laboratories. Now, the reason for showing that is not to say that those particular companies are the ones that are going to fall, but they're the kind of companies that you should be very cautious about investing in unless they can demonstrate that they are growing revenues quarter over quarter in the next year or so at a rate that would justify those valuations. Even at that level, you probably won't see their prices rise that much because most savvy investors know that they're currently overvalued at a price to sales level, which is customarily the valuation that we use for pre-profit companies. And so therefore, we have to let those valuations, or rather let revenue catch up to those valuations. We bring up the E, keep P the same, it brings down the ratio. And also bring up sales, of course. Now, what about the bottom of the list? Here are the companies at the bottom of the Nasdaq 100 in terms of price to sales, but also in terms of price to earnings ratio. So the thesis here would be that these are companies that if they can demonstrate strong growth in their core markets, they have room to grow relative to the ones that are going to fall. Look at some of them up there. Biogen, again, pharmaceuticals, those are wild cards that can go either way. Electronic Arts, a game maker. Intel, under severe pressure from AMD, of course. Regeneron, another pharma company. eBay, strangely enough, still relatively sanely valued as a company at price to sales and price to earnings ratios. JD.com in China, Cisco, American Electric Power, Dollar Tree, Amgen, Checkpoint Software, O'Reilly Automotive, interestingly enough. A lot of people might be fixing up used cars over the next year, so that might be a good bet. Vertex Pharmaceuticals, Exelon, Xcel Energy, Mondelez, Align, Comcast, CSX, that's trains, PACCAR, that's big trucks, PepsiCo, and Fox Corp. So again, I'm not saying that these are the companies that are going to necessarily see gains over the while, but it's a pretty good bet that if you're going to make money in the stock market this year, it's going to be amongst those kinds of companies that currently have low price to sales ratios, low price to earnings ratios, but are exposed to a consumer market, and likely to grow quickly as the economy grows. So just to give you an example, I'm going to pick this one out of a hat. PACCAR. PACCAR makes diesel engines and also basically is part of the trucking industry. If we see an increase in investment in transportation, for example, school buses, I've talked about them before. If you see 18-wheelers, they could do very well. They could see double-digit gains this year, given the low price point they're at. They're at a PE of about 25.73 and a price to sales about 1.78. The key thing is that if money is going to rotate away from that pink line that I showed earlier, which is the Nasdaq 100, and towards the green line, which is everybody else, then the smart thing to do is to take ye profits as ye may and rotate them into the stocks that have room to run. But the key thing is watch those quarterly reports, folks. Watch the earnings. That is the most important thing for the next 4 quarters at least. This is Ted Bauman signing off. I'll talk to you again next week.